Welcome back. Now let us continue. Now we look into personal liability company. When you look into the definition of your personal liability company, this is very similar to a private company. The difference is that the directors of a personal liability company are jointly and severally liable for all the debts and liabilities of the company. This means that the directors have unlimited liability. So what are we talking about when we talk to your personal liability company? It is similar to a private company. The only difference is that directors here will be forced to have interest into the success of the company. Because remember, directors run the day-to-day activities of a company. This implies that now, should the business fail, it is the decision that was taken by the directors when they were doing the day-to-day activities. So personal liability company tries to cap that or tries to reduce the lack of interest by directors by making sure that now, should the company fail, directors will be liable for the liabilities that they have created for the company. So that is why we say the difference is that directors will be liable for the liabilities or failures of a company. But another difference is that the name of a personal liability company ends with INC, and the name of the private company ends with the word PTY Ltd. Now looking into the characteristics of a personal liability company. The company name must end with letters INC, meaning incorporation, and then the directors have unlimited liability and they are jointly liable for the debts of the business, even if they are no longer or they are long out of the office. And then the memorandum of incorporation should state that it is a personal liability company, and they must at least have one director on their board of directors. And then note again that other characteristics of a personal liability company are the same as the private company, except the above mentioned characteristics. Now, what are the positives? Positives. Note, the advantages of a personal liability company are the same as the advantages of a private company. So keep that in mind when you study. So basically, when you are studying your private company, you are also studying your personal liability company. Then, what are the negatives? The disadvantages are also the same as of the private company, except that the idea of directors of the personal liability company having unlimited liability. So this is a disadvantage that applies to directors. Then, public company. A public company is registered to offer its stock and shares to the general public. This is mostly done through the Johannesburg Security Exchange, JSE. What are the characteristics of a public company? A minimum of one person is required to start a public company, and then the company name ends with letters Ltd, and then it has a legal personality and therefore has unlimited continuity, which would still apply to a private company. Then it requires 3 or more directors or 3 or more shareholders. Then, a prospectus is used or issued to the public to raise capital, meaning a public company is allowed or sells shares to the public, meaning they can invite anyone in the communities to come and buy shares, whereas with the private company, that will not be applicable. As we proceed, what are the advantages of a public company or registering your business as a public company? The business has its own legal identity and can own assets and property, and again, this means this business can be sued. It is easy to raise funds for growth through the sale of shares. Obviously, you are selling to the public. Then, shares have a limited, or shareholders have a limited liability for the debt of the company, or shareholders may only lose the amount which they have invested. So this saves shareholders. Then looking into the negatives, they must disclose all the financial information which can be used by its competitors, and large amounts of funds are spent on financial audits, and then directors may not be motivated to work very hard because shareholders decide on the directors' remuneration, meaning the amount paid to directors for working is determined by shareholders, which may discourage directors from making the company to make more and more money. Now, let us look into the differences between a private company and a public company. This now is your difference. Your private company may not offer shares to the general public. That's your private company. But your public company trades its shares publicly on the Johannesburg Security Exchange. So they are allowed to sell to the public. That is public company, but the private company may not do so. So shares are not freely transferable for a private company, but with the public company, shares are freely transferable. And then a minimum of 1 director is required for a private company, but a minimum of 3 directors are required for a public. And the name must end with Pty Ltd, but the name must end with Ltd for a public company. And then annual financial statements need to be audited and published. But when you look into the public company, with the private company, annual financial statements, meaning your income statement, balance sheets, will not need to be audited and published. They will not need to be audited and published. But when you're looking into your public company, annual financial statements needs to be audited and published, because remember, shares for a public company are sold to the public, so they need to be published so that shareholders who are within the communities can have access to them. Then we have state-owned companies. A state-owned company has the government as the majority or major shareholder and falls under the Department of Public Enterprise. These companies take on the role of commercial enterprise on behalf of the government. What are the characteristics? The name ends with letters SOC, state-owned company, and a state-owned company is listed as a public company again. And then another character is that it is owned by the government and operated for profit. This is your Eskom, for instance. Eskom is owned by the government and is operating to make profit. It requires 3 or more directors or 1 or more shareholders. And then register. It is registered with the Registrar of Companies by drawing up Memorandum of Incorporation. So what is the impact? We are looking into the positives and negatives of a state-owned company. Profits may be used to offer finance to other state departments, and it also offers essential services which may not be offered by the private sector, like the water, like the electricity that is being provided by Eskom. And then you have prices are kept reasonable, and it creates a sound competition with the private sector to make services affordable for more of the citizens. And then what are the negatives? It may result in poor management, as government is not always as efficient as the private sector. That is the problem with your state-owned companies. Inefficiency due to the size of the business. Because it is providing now services to the company, it might be difficult to provide efficient services, and it often relies on government subsidies, which may not always cover all the company's expenses. Then we have non-profit companies. A non-profit company or an NPO is not formed with intent to make profit, but established for public benefit. That is your non-profit company. What are the characteristics? The main aim is to provide services, not to make a profit. That is 1. Number 2, they are funded by donations and foreign funding. That is number 2. And then number 3, the name of the company must end with NPC. And then as we proceed, all profits must be used for the primary objective of the non-profit company, which is maybe to provide services to the community, and then it must prepare the memorandum of incorporation, and qualifying NPCs are granted tax-exempted statuses. Then what are the advantages and disadvantages? Surplus funds are used for the solely primary objective of the organization to further the goals of the business. So the aim is to grow the business, provide more services. That's why we're saying surplus funds are used for the primary objective for the organization or the goals of the organization. And then they provide social services to various communities. And then donors receive tax deduction, which motivates them to invest in non-profit companies. Now, what are the disadvantages? They need professional assistance to set up the organization, and it does not generate enough capital to cover the expenses, and donations may not always be enough. Those are the negatives. Then, the last form of ownership is your cooperative. A cooperative is a traditional way for a group of interested parties to get together and share their resources or infrastructure and cost to achieve better outcomes. This would be done maybe by a community living in a particular village, for instance. Then a minimum of 5 members can be required to start a cooperative, or will be required for a cooperative to start. The word cooperative limited must appear at the end of the name of a cooperative, and they are motivated by service rather than the profit. Then another aspect is that they are managed by a minimum of 3 directors, and then as we proceed, decisions are taken democratically. Then legal entity, and this is a legal entity and can own land and open a bank account. What are the positives? The advantage is that they have access to resources and funding, and decision making is done by a group, and each member has an equal share in the business. And then when you're looking into the disadvantages now, is that decisions are often difficult to reach and time consuming, and then it is difficult to grow a cooperative, and very few promotional positions for staff within a cooperative. So those are the negatives, and we have looked into, remember, the characteristics, and the important aspect is to understand that your limited and unlimited liability would be applicable differently to each form of ownership and will form a source of advantages or disadvantages, because we talked about characteristics and we also talked about the impact of each form of ownership to say, should you register this, you should know what are the positives and what are the negatives. So this would help you to make an informed decision one day when you start your business, and you'll be in a better position, obviously, to choose a form of ownership that would be the best for you and the type of business you would be having. So with that being said, thank you for watching. Keep well. Goodbye.